Welcome to our latest installment of Argent Bridge's Coffee and Conversations. I'm Joe Gallimore. I'm the partner in charge of investment management here at Argent Bridge. And today we're going to be talking about smart investing, a deep dive into the state of the market. And today I'm very glad to have with us Tom Galgano Jr. He is our client advisor from Vanguard. His value to us is to not only keep us informed of all the Vanguard products, but also keeping us apprised of all the wealth of research that Vanguard puts out on key investment topics, which I will speak about in a minute. Tom's been with Vanguard for a little over 10 years. He's originally from Long Island, New York, and he graduated from Villanova, which ironically is right down the street from Vanguard Funds. So sounds like he, on graduation day, just walked out of the gates and applied at the first place he saw. So
something like that.
Yeah. Tom now lives in Nashville, Tennessee, and he is actually a published musician. So if you see his name on the Billboard charts later on, you can say you met him here first. Before we get into things, I want to mention to everyone that there is a Q&A button at the bottom of your Zoom screen. At any point you think of a conversation, just pop that up, type in a question, and I'll be able to see it. And we'll work that in as we go. Of course, we'll have time at the end for questions, but this is just a discussion. So please fire away as you think of them. Before we get into the meat of the conversation, I wanted to provide a little perspective on Vanguard for our listeners. And Tom, after this, feel free to add to it or even educate me if I missed the mark at all. I tend to think that the average citizen thinks of investing kind of like exercise or kind of like oral care, flossing your teeth. It's something they know is good for them and they feel obligated to do it once in a while, but it can maybe feel like a chore or just casual interest. So for those without a professional team, like us, they might just go on Google and say, how should I invest? After sifting through 2 pages of ads, they'll come across this large discussion in the investment world about active management and passive management. Which one's better, the merits of both. Vanguard essentially pioneered the concept of passive investing. And since then, Vanguard, the name Vanguard has become synonymous with basically low-cost indexing. But there's actually a lot more to it than that. And first of all, Vanguard doesn't only offer index funds, they offer actively managed funds as well. But there's a lot of effort Vanguard puts into resources for investor and advisor education on a wealth of investment principles like low-cost strategies, investing for the long term, ESG, how behavioral tendencies affect your portfolio, so much more. So I'm sharing all this just to make sure that our audience understands Vanguard on a deeper level, like we do on the professional side, just in case they may understand them as a 1 or 2 trick pony, which would be a very unfair generalization. So Tom, I hope I added some good perspective there on Vanguard for anyone who didn't have it. So let's get to it. Deep dive into the stock market. So I'm just going to ask a general question off the bat. What is Vanguard's assessment of the stock market right now?
Yeah, sure thing, Joe. And thanks so much for having me on. Before everybody hopped on, Joe and I were just talking about NCAA hoops. So, lots of excitement out there. We'll see if COVID plays a role in the basketball, but that's where I'm going to be directing my analytical firepower for the evening after this call, is sitting down and crunching the numbers and filling out my bracket. But I found that the more you know, the more dangerous you are to blow up your own bracket. So let's turn to something that is less gambling oriented and a little bit more hopefully based on fundamentals, is the stock market. And so, Vanguard's perspective on the markets is, hey, the only certainty is that they're going to go up and they're going to go down over time. So your return is what you hope to earn over time, and the volatility you endure is the price you pay for that return. So, you're going to experience ebbs and flows as the cycle of the market plays out. And Joe, you and your team are tenured veterans of that experience, as well as I'm sure many of your clients are. So where are we now? We're coming off the midst of the limit down era. And that experience back in March, I remember very clearly March 10th, 11th, and 12th of the limit downs in the market, the circuit breakers that prevented the market from going into free fall, we've come a long way from there. We've reached new highs in the S&P and the Nasdaq, and we're starting to ask the question that we were asking back in February of 2019 or 2020 rather, and that's our market's overvalued. It's interesting. You were kind of mentioning my musical background, so you're a finance nerd when you name your band after a Warren Buffett quote. And so we named our band Swimming Naked, which is supposed to be built off of the Warren Buffett quote, "When the tide goes out, you'll see who's been swimming naked," is the quote. And it's about risk in the marketplace. And so we hear a lot of folks trying to reach for yield in their portfolio, reach for return, and it seems like the appetite for risk is higher now than it almost ever has been in history. As we look back, we compare this to the 2008, 2009 peak. We compare it to the tech bubble back in the early part of the 2000s. We look at equity valuations, and we certainly are not excited about the future of outsized return potential. But that said, we don't think that they're terribly stretched or overvalued if you compare them to a long-term average. And so, for those out there that are familiar with the CAPE, the cyclically adjusted price to earnings ratio, which takes into account long periods of time to try to answer the question, are the equity markets overvalued? And so when we look at our cyclically adjusted average of PE ratios, we actually adjust it for where rates are, which actually makes the tolerance band for the level of PEs a little bit higher. And we adjust for lower rates of inflation in the marketplace. And so what we get as a result, once you've made those adjustments, is that the markets seem stretched, but we're certainly not in a bubble territory where returns in equities are completely hopeless moving forward. There is still an equity risk premium that we believe exists.
Good. Good. Yeah. The market's hit all-time highs a couple times in the past. Well, it was doing it in January, and then it came down in February, and now it's doing it again in March, as it always seems to do. It just retests highs. Being at a high, being at somewhat stretched valuations, it seems like that implies risk to me. That implies downside risk. Speaking of that risk, does the coronavirus and the vaccine efforts and the results there, does that kind of still hold the reins, or at least hold a trump card if it decides to reel its ugly face? Or has the market, with its strong performance, because there's I think 3 or 4 vaccine options now going on worldwide, has the investing participants, have they looked past the virus into a mostly vaccinated world and said, all right, this is something past, we're just charging ahead? Or does the coronavirus still wield some weight here?
Yeah, it's a really good question, Joe, and a prescient one as your team is trying to figure out how to deploy the capital of your clients in the most efficient way possible. I mean, by all means, this is still the coronavirus story. If you rewind back to, again, January, February of 2020, what were we talking about back then? What were the big issues? It was really dominated by the Chinese-U.S. relations, right? I mean, that was the big story. Have you read anything about that lately?
I forgot it existed.
Totally, yeah. It's funny. We all are dealing with the crisis du jour, and we are still dealing with coronavirus as the crisis du jour. The question is, do the voting machines of the market, that is the cooler heads of the market, not the euphoria that you see in some run-ups and momentum in the market, but the more discerning investors, what have they priced in? And so there's really a few ways to answer that question. When you look across markets, you could ask yourself that question in the context of fixed income markets, which I'm sure you'll ask some good questions about later, or in the context of equity markets. Well, if you back up to GDP, our projection is that with the $1.9 trillion injection that was just signed into law, we could see an expansion of 2021 US GDP by about 2.5% on top of what we were already expecting. with one fell swoop of the pen. Now, it's not that easy. Obviously, there's a lot that went into the passage of this legislation. But the question remains, has the market fully priced this in? Is it priced to perfection, which is a term we use in the industry, saying that our markets, overly optimistic, essentially. And so there could be some of that. There could be some of that. Right now, what we're seeing is that inoculation rates, folks that are getting the vaccine, are somewhere between 2 and 2.4 million a day, which is a really healthy clip. It's a good pace. And so markets are optimistic. We think for the most part, they've got a good reason to be optimistic. And we're just being cautious as you are, because this optimism has a tendency to get over its skis at times. Yeah,
good way to put it. I like that. Because if you're over your skis too far and you fall, it can hurt.
Exactly. You got it.
One thing we talk about with our clients in the reviews currently is the case for global growth, not just growth in the US, how's the virus affecting us, but the economies all over the world are resetting and recovering from the damage that's been done by the virus. What do international and maybe emerging market stocks have going for them now that they didn't maybe 12 months ago when this all started, or even 36 months ago, 3 years ago, when they were kind of decoupled from the US growth story?
Yeah, it's a really good question, Joe. A lot of folks have been focusing inward on, US investment.
It's happening here.
Right. Because it happens in your backyard. I mean, you see companies like Johnson & Johnson every day. You see companies like McDonald's when you drive to the store, drive to work. You see these American car companies all over the place in our communities. And especially in DC, you see a lot of these local defense contractors that generate a lot of revenue, tangible revenue. We're not talking about some of these tech firms that don't have revenue yet. And so it's difficult to imagine a world outside the US that's worth investing in, because we have so much opportunity here.
Yep.
Here's kind of our perspective. We're big fans of non-US investments. We think that diversification needs to be a key tenet of a long-term investment philosophy. And that involves, non-US investments the same as it involves US investments. Now, the global market cap of what's out there, if you were to measure all of the, the companies out there and float, the US accounts for about 55% globally. And so outside the US is about 45%, which, we are still the biggest market in the world by a lot. But are you willing to neglect almost half of all investments out there? Right. We call this home bias. And I know that you and your team have studied this with clients and had discussions with clients about home bias. But we truly believe that where we are now, there's more opportunity for outsized return outside the US than there is domestically here. So we would advocate to continue to think about a non-US allocation in the portfolio that's appropriate for the client. And our projections are that we'd expect outsized returns from non-US equities, more so than US equities for the next decade.
Okay. Anything specific for emerging markets? Are those still just kind of a little brother to the international stock? Or how big of that 45% of the investing possibility set is emerging markets? Is it standing on its own yet? Is it moving in tandem with the international stocks? What's going on there?
Yeah, it's a really good question, Joe. I mean, EM it's interesting, because there's a lot of good things happening, and it's got more of a capability to grow faster, especially if you're thinking about Asia emerging market countries. We compare those to like Latin American emerging market countries, where there have been more headwinds in Latin America. But there are some interesting stories playing out in emerging markets. What we've seen over the years is that a lot of advisors have an overweight to EM, and it just hasn't really, materialized in terms of returns the way that it maybe had in the prior decade, 20 years ago. And so that's not to say that we should dismiss EM. It's an important part of the portfolio, but it is going to be riskier. And so, if it's appropriate for clients to access these markets, you can't ignore China.
Yeah.
You can't ignore China. it's pretty interesting when you think about, again, almost this tale of two cities between Latin America developed and let's say Latin American EM and European EM versus Asian emerging markets. And, there is a cultural difference between how Americans and Europeans deal with a pandemic and the way that Asian cultures deal with a pandemic. They tend to be a little bit more experienced, let's say, in pandemic times. I'll give you a quick example. One of my best friends from college, he lived in the dorm next door to me at Villanova. He got married a few years ago to a Chinese girl from Beijing. And, only child, exactly what you'd expect from a Beijing family. But they had a child, Matt and Ivy, back in February. So right before everything hit in 2020. And her parents came over on the last flight from Beijing to China. And I got to say, Matt is not known as being the most conscientious person. He never struck me as somebody who'd really buckle the belt and be very, very serious in a quarantine. But with his in-laws around who are Chinese, they've been, an abundance of caution. I've haven't heard anybody in the U.S. that's taken as many precautions as they have. And so I think that the lesson we can learn from that observation of Asian cultures is that they just weather, downturns caused by health risks better than a lot of other regions of the world do. And so, you saw China weather this storm impressively well, and other Asian economies weather it impressively well.
South Korea was a poster child for that.
No doubt. You think about companies like Samsung. Go pull Samsung's 10Q and take a look at, how they've done, and compare them to like an American electronics company. The other thing I'll say is, China is a big part of the conversation. They represent about 30% of, our emerging markets access point, our product. And, you got to be aware of the goals they have. They've got some lofty goals. They just met, I think it was last week or earlier this month, and it was the annual National People's Conference. So it's all the communist leaders get together in the Chinese government and make forecasts about where they think the economy is going. And they believe that the economy should be able to double in size by 2035 is their goal. They also set a growth target of about 6% for 2021, which Vanguard actually believes is low. We think it's closer to 9% for 2021. And then over time, we're expecting to see something like 4.7% to get to their goal. Let's take that and compare it to the U.S.'s long-term goal, which is somewhere around 2% growth, so almost double, a little more than double. So there are plenty of prospects out there for opportunities to invest in emerging markets, and we think again a diversified approach makes the most sense.
Yeah, and hopefully any sort of cultural response difference that you alluded to sets them up for a faster recovery, from everything.
Yeah.
I'm going to switch gears for a minute. We are getting a lot of questions about clean energy this year and, electric vehicles, alternative energy sources, non-fossil fuels, things like that. Does Vanguard have a view on this?
Yeah, it's a good question. It's hard not to pay attention to, especially as stewards of a global climate regime where we've identified carbon emissions as an offender. And you've seen a lot of these automobile companies setting goals to become cleaner over time. And, it's interesting. We don't have a firm view per se that we are heralding from the rooftops, but we've definitely paid attention to it. And when we think about stewardship, when we vote our proxies, when we vote, our shares as, one of the largest holders of public companies in the world, we do have a set of standards we abide by, and clean energy is an initiative of ours. We try to influence these companies to be more conscientious about their impact to the climate over time. The other interesting point that I'll say, Joe, is that some of the old fossil fuel juggernauts, let's say Chevron, ExxonMobil, these companies have been somewhat vilified over time as being the biggest offenders. But if you look at the expenditures for who's really investing in clean energy, they're leading the way, which is an interesting sort of dichotomy of worlds. They're the bad guys and they're the good guys almost when it comes to clean energy spending. And so one thing that I'd encourage folks to take a look at and be more aware of is the fact that a lot of these big companies, which I think many social activists or progressives would consider to be the problem, and I'm not disagreeing with that per se, but they are investing very heavily in renewables and cleaner energy sources.
Okay. Interesting. I was going to ask a follow up to the clean energy question, in that, it's a feel good story and it's social impact investing. But the rub there is that a lot of these funds were up around 100% last year, when there was this humongous shift in capital going into a lot of those companies like Tesla or something like that. So the return on those funds is almost prohibitive. You're saying, why am I going to buy something that just doubled?
Hmm.
Now you mentioned, and I was gonna ask, does clean energy fall into the category of it's a trade, or is this an investing theme that's hit critical mass that you can keep going with? Sounds like it is, based on Vanguard's incorporation of it in standards. But your mention of the fossil fuel juggernauts, energy was by far the worst performing sector last year, and has been for 2 years, I think, down 40% each year. It's making a comeback this year. A lot of those juggernauts, are they good buys for the clean energy play? Are you seeing those in clean energy funds, or are they still too tied to oil and gas that they are not qualified?
Yeah, it's a good question, Joe. I don't know that I'm equipped to really comment on the trade. We've got a very diversified perspective here at Vanguard, and again, while we do try to vote our proxies in a conscientious way to create the future world that we ourselves like to live in, that we think is sustainable long term, I don't know that we have perspectives on how to play the trade or how to invest in it. Right. One thing I will say, you do see a lot of these ESG companies, and for those out there who aren't familiar, ESG is environmental, social, and governance investing. And so it's a trend, it's a regime. We think it's here to stay, where folks, instead of attempting to change the world or the pace of the country with their vote, it's almost like a second vote. I'm going to vote with my dollars too, towards something that I consider to be a noble cause, which is a very subjective phrase. But through that subjectivity, many of these ESG, providers have stripped out the big energy companies. So, despite them being big spenders in renewable energy, I think a lot of these indices have removed them because of, some of their ties to traditional fossil fuels.
Yeah, makes sense. I want to stick with investing themes and talk about a little bit of the latest buzzwords or buzz topics that you're hearing in the headlines. Tech stocks have basically ruled the schoolyard for the past 12 months. The ARK Innovation ETF and the whole family of ARK ETFs, they're getting a lot of press lately. And of course, the fear of missing out on Tesla stock has been just overwhelming for the past year. Hindsight is always 2020. From right now, what is the cautionary case that an investor must consider when they're thinking about dabbling in these names?
Yeah, you hit on one of my favorite acronyms, FOMO. I think we've all had some form of FOMO, this year, especially as we're, thinking about all the great trips we had planned. Right. That didn't quite make it to fruition. We had a trip to Ireland planned actually last year, and we didn't get an opportunity to go for obvious reasons. But having this FOMO, this human desire to keep up with the Joneses, to get what others have achieved, is very much so alive and well. And you've seen this in the Tesla trade. You've seen it in the Bitcoin trade as well. Where folks see that something like Bitcoin was up 500% last year. What about me? How do I get into that? How do I experience those returns? And so I'd take the FOMO mindset and I'd combat it with something else that I just learned about the other day called FOLO. FOLO is the fear of losing out. And so imagine that, an asset that's run up 500% last year, all of a sudden runs down 500% and you were in it for the decline. That's FOLO. That's imagining the pain of getting it wrong, not just the exalting the pleasure of getting it right. So I'd encourage clients to really balance their perspective on risk and not only think about the upside potential, but also the downside potential.
Interesting. I've never
And
heard.
so for
Yeah, and visualizing how it feels if your investment that you put, goes down sharply and probably quickly, could probably be a powerful motivator. And I always caution clients, have a thesis for what you're investing, and if only thesis is I want those returns, then that's dangerous. So
couldn't agree more, Joe. It's a great point.
I'm gonna borrow a photo and put it in
take it
to my conversations. Okay, I'm gonna switch areas of the portfolio right now and go over to bonds because almost all of our clients own bonds. Trillions of dollars have been pumped into the economy, and trillions have literally been put into consumers' hands. So that means the consideration or the fear that rises is inflation. Help us understand, why does inflation matter? And if there's a real strong case that it's going to go up, what should we do?
Yeah, inflation is one of those interesting components of finance theory that many folks struggle to really understand. And as we heard Jerome Powell, our Fed governor, or head of the Fed, spoke the other day, he explained that a 2% inflation is healthy. That's kind of what we're targeting as an economy. That's what many developed economies target. Now, what does inflation really mean for you and your clients in their day-to-day lives? It could potentially mean an increase in food costs, which we're actually seeing come to fruition. It could potentially mean an interest in energy costs, which we've been very fortunate not to really have seen for years. So that could materialize as a direct impact to the American consumer. But also, it potentially erodes your bond returns. So, if you've locked in a coupon payment on a bond of, call it 3 or 4%, and it's a 10-year bond, and you can expect to receive 3% every year for the next 10 years in your coupon, but inflation goes up, it can eat away at the value, the spending power of that 3% coupon that you're getting. And so that can be very dangerous for a bond holder over long periods of time. It needs to be considered. It's a risk. The flip side of it, which is kind of interesting, is, well, one, wages will oftentimes keep pace with inflation. So you'd expect over time for wages for folks who are still in their earning years to continue to rise with inflation with somewhat of a lag. There's some debate about what that lag is and whether it's different industry to industry. For the retirees, it's a different story. If you're not earning an income currently from a profession outside of your portfolio, it's certainly a very real risk. The other point about inflation, Joe, which I think a lot of people don't think about, is that if you hold debt, let's say it's a mortgage or a student loan, inflation is actually your friend. Because inflation, so it's interesting. Inflation can actually erode the value of your debt. And so if you owe $20,000 to Michigan University, your favorite to win the NCAA tournament this year.
Okay.
But that $20,000 you owe them today, a couple of years from now gets eroded away because of inflation. And say inflation's 2%, right? So the money you're going to use to pay back that loan in the future is actually going to be less worth less to you as an investor. And so essentially holding debt is actually an inflation hedge in some respects, which is an interesting concept. There's two sides to every coin. So as a bond holder, you're investing in debt, you're holding it. But as someone who has a mortgage or student loans out, it's like you're issuing a bond. So it's the other side of it.
Okay. I've never heard it explained that way. That's good to think about. Time value of money is something that the average investor needs explained, and it's good to hear it. Good to hear it illustrated from kind of the reverse side of that. So with inflation, potentially happening in the next 2 years, 2% is a good number. What is the upper range that you want to see? You hear stories about decades ago, there was hyperinflation, inflation
right.
8%, 13%. And then you hear stories of Venezuela where inflation is in the high double digits. obviously those are extreme cases, but it sounds like we're talking about more than a healthy number. So what do you do in your portfolio to I don't know, react to that?
Yeah, it's a good question. And I think, Joe, now more than ever, there's some extra tension around potential runaway inflation. And it's because you've got this massive stimulus. I'm sure everyone's paying attention to the amount that the government is injecting into the economy. And we've seen savings rates go up in the United States markedly, almost double where they were pre-crisis. So folks are saving more, which is great. It's why you're not seeing inflation kick up quite as much. But we do think that there's going to be, at Vanguard, we think that there's going to be a spike in inflation on a temporary basis, not anything, that's going to persist for years like we saw in the 70s with energy prices really being the driver. But we could see certainly a spike in inflation. One kind of word of caution, there's a famous phrase from an investor named Howard Marks, who I'm going to butcher this a little bit, but he describes, capital markets as going from pretty good to not so hot. That's kind of the range, pretty good to not so hot. And he kind of points at the media and highlights an interesting fact that the media, according to them, markets go from exuberant and, exciting and euphoric to completely hopeless. And so, as you hear news reports about inflation, keep a longer term perspective, because we probably will see a spike in the next couple of months, and we're kind of already seeing that materialize. In the portfolio, what can you do about this? There are some inflation strategies on the fixed income side that I'll kind of leave it to you to talk about. But equities do a pretty darn good job of hedging inflation over longer periods of time. So, if you've got some equities in your portfolio, even if you're a retiree, a portion of the portfolio that is in equities will act as an inflation hedge to the portfolio over longer periods of time.
Yeah. Yep. Right in line with what we coach our clients on. Our theme for this month is kind of gearing towards early retirement. And I'm sure everyone's heard of the movement out there, FIRE, Financial Independence, Retire Early. That's an extreme example. That's where you save every dollar you can, you invest every dollar you make back into growing it, and you limit your expenses to the bare minimum so you can retire by the time you're 33. Very few people accomplish that, and it takes an unbelievable amount of willpower. But I'm wondering what Vanguard has as far as principles that would help accelerate the retirement situation. Your retirement happens when you have enough to live the way you want, right? There's no minimum hurdle amount of money that is needed until you have enough for you. What has Vanguard research yielded as far as making that happen on a steady pace?
Yeah, it's the multi-million-dollar question, Joe. Everybody wants to achieve that financial independence. I'd call it mailbox money. Get paid to go sit at home and watch Netflix all day, right? That's kind of the dream. And I've heard some unique ways to create that. But as a firm, we're true and tested. We're boring and enduring, I like to say. There's not a lot of what I call cuteness to our approach. It's pretty simple, but simplicity is king in investing, and keeping things really clear and really simple and not obfuscating your goals is the pathway to success from our perspective. And so, the house that Jack Bogle built, which is the Vanguard's founder, is really built on four main principles for investment success. The first one is to define your goals. You made a really good point earlier about, what are you investing for? Is it just for return, or do you have a specific goal that you're trying to hit? Get specific with goals. If you can define your goals and define your investment objectives, you can keep true to your plan when markets change, and not change your approach if your goals haven't changed. I hear a lot of folks that go out there and if markets have a big move or there's something in the economy that occurs, they say, let's change our approach. But a lot of advisors I work with will sit down with the client and say, well, what's changed in your life? Well, nothing. Okay, so why would we change our approach? Your goals haven't changed.
Yeah.
And so there's a lot of value to setting goals and staying true to them. The second one is a pretty basic one, but it's really important, and it's diversification and balance in the portfolio. And so we truly do believe that owning it all, in any given year is the best approach. And in terms of risk adjusted return for a unit of risk, which is really what we're talking about here, diversification is the most effective way to maximize that, in our experience, and it's scalable. So diversification is a big one, and that's not just in the equity side, but the bond side as well. We think diversification is really important on both sides of the portfolio. Furthermore, we are an indexing pioneer at Vanguard, but we are probably even more so than indexing proponents, we're low cost proponents. And so we feel like, the lower your expenditures are, the more you get to keep. And, the only guarantee in this business is really, the expenses you're going to pay. And so if you can find a way to minimize the expenses that you pay to access an investment, which I know your firm does a nice job keeping costs down, you can maximize the return that you take home. So the third one is cost. The fourth one is a really important one. And it's discipline. Every day there's a million forces trying to tug you in this direction or that to change what you're doing. And, Jack Bogle, who I had the pleasure of meeting on several occasions, had a famous saying. It was, "Don't just do something, stand there."
Right.
Don't just do something, stand there.
Yeah.
And so, the idea is simple. It's pick a plan, get it, find a low cost way to access the investment markets, diversify your portfolio and keep costs low over time, and then keep doing it. It's really easy to get distracted by someone who's talking about, a short-term investment where they made some outsized return. But this is very much so, in our opinion, a slow and steady wins the race game. Yeah.
Excellent answer. That one was loaded. Thank you. And it actually segued nicely into the last question I had planned. During choppy markets, let me back up. Our clients, they have all of their portfolios are a hybrid of active strategies and passive low cost strategies, like you alluded to. During a lot of market choppiness, we highlight that active strategies are more, by default, more apt to take advantage of price dislocations and things like that. What are some advantages of a passive approach through market cycles, and especially kind of an environment we're in right now?
Sure. So, the advantages of having indexing as part of the portfolio are, really true to the four Vanguard principles I just mentioned. I mean, a lot of these index products are really diversified. They're really low cost. And there's also a tax efficiency component, which I know your firm pays close attention to in controlling the tax bill for clients. So, index funds tend to have lower turnover than active funds do generally, not all the time, but as a rule of thumb, you see these index products that are just tracking the market, and there's just not a lot of turnover, which turnover is really when, a fund will sell a security or buy a new security. And so because you're not selling as much, you're not recognizing capital gains as much, which over long periods of time can make a really big difference on the after-tax returns of these portfolios. So yeah, there's a lot of advantages to indexing. It's one way to do it. It's not the only way to do it.
Right. Yep. Amen. Well, there are no questions in our queue right now. We are right at 4:40. So I want to thank Tom Galgano Jr. very much for being with us today. Sir, you provided a lot of great answers and a lot of good sound bites. I'm going to borrow some of those in my discussions with the team and our clients.
Please do.
I want to thank everyone who attended today, taking time out of your busy schedules to spend a little over half an hour with us at Argent Bridge. We hope you found this valuable. If you have any other questions that you thought of that you were shy to ask, please email them over to me or give me a call. My email is joe.gallimore@argentbridge.com. If I can't answer it myself, I'll bring it back to Tom, and he can bring it to the very smart research analysts they have over there at Vanguard. So thank you very much for attending today, and your team at Argent Bridge, thanks you very much. And we're here working hard on your behalf, and we hope to speak with you soon. Everybody be well. Take care.
Thanks, Joe.